Hello, everybody. Welcome to our live Google Hangout, taking a look today at momentum. And one of the things that I've been noticing in your action plans is this lack of looking at momentum. You've got some great strategies for picking out stocks which are going to make money. But now we need to take that one step further and try and find out which stocks are going to make the most amount of money in the given set period of time. So that's one of the things that we really want to take a look at in today's lesson. And as we move forward to next week, think about how we're going to incorporate that in. Now, I've suggested that to some of you, it'd be something you consider starting to incorporate into your trading, but hopefully today you'll get a better sense of what that's all about. So I'm just going to share my screen here with you, and I'm going to go into a, hopefully, in one moment here, into a PowerPoint presentation. So one moment. Doesn't seem to be wanting to pull up on my screen here, interestingly enough. I just have to close out a couple of things, which and it's fine in the time being as we I'll try this again as we wait for some people to perhaps come online. Let's go here. I'll also, while we're here, I'll pull open the chat, take a look and see if there's anything for the Q&A. Nothing's come up yet for the Q&A. All right. I'll just pull this. I'm gonna try doing this again here. Seeing what happens. Okay. There we go. So what I want to show you is, again, this idea of momentum. So if we take a look at this blank slide here, I'm just going to use this to draw on as much as anything. Let's open up this screen a little bit and put in the layout. So one of the things and one of the formulas when we look up momentum and investing that we see is this one: M equals V, take away V, and usually there is a subset N here. And what this is really saying is that momentum is equal to the price today, take away the price in the past, where N is the number of days, N is the number of days in the past. And most of the time what we look at is 10 days in the past. So for example, if we can think, here of a stock whose price right now is $50, and 10 days ago its price was $42, then its momentum would be, and we don't even need to measure this in dollars, its momentum would be 8. Now we may even want to put that into a percentage. If we think about this intuitively, let's take a look at another stock whose price today is $50. Its price 10 days ago, though, was $48. So if I asked you the question, which of these two stocks would you like to purchase? Well, how would they look in a graph? Which one is going to give us the better return? And I'm just going to draw a quick little graph here of both of those stocks to give you a sense of where momentum, calculating momentum, is going to help you out. So let's say that this part of the graph is 10 days ago. right on the line here is 10 days ago. And then over here is today. And if I was to ask you which one of these two stocks would you like to buy? Well, let's put that first one on here. And I'm just going to color that. I'm going to color that red. And that first one here, this is going to be our, it's going to be depicting our $8 momentum stock. So in other words, to get to 50, it started off at $42. I'm actually going to move it. I'll show you why. I'll move this down in a second. And that's where it was 10 days ago. And this one is, get the right number here. And this one, and it's gone up to 50. So obviously we've had a very nice change, a very nice increase in the price. How about this stock right here? And I'm going to actually color this. Let's color this, what the heck, let's color it purple. Now, with this stock, it too right now has arrived, today has a price of 50. I'm going to color its line as purple as well. But it started off at a much higher price. It started off at 48, didn't it? And so when we're measuring the momentum of this stock, it has much less momentum. In fact, it only has a momentum of 2. Based solely on that, then, which one of these two, given that they're both 50 now, would you have preferred to have owned 10 days ago? Well, clearly the one that was 48. And we can see that in its momentum number. It grew by $8, whereas this one grew by 2. How can we now take that idea, this idea of momentum, and create a little bit of an indicator? Well, we can track momentum. So I'm going to take, again, this is a 10-day momentum number. I'm going to take that and put it in here. Well, let's say tomorrow do the same thing. So tomorrow at the end of the day, the price was $51. And when I look at the price 10 days before that, I find out that it was 38. So what do I see? I see that the momentum here was 13. So what I'm seeing day over day is that the momentum is beginning to increase. Momentum here is beginning to increase. In other words, the amount of change in that stock price is getting larger and larger and larger, and it's in a positive direction, which means that we might want to sell this stock. Let's take another example, and let's say that we had just today measured that momentum at 8, but instead of it being 8, when I measure it tomorrow, we have 51, but it turns out that 10 days ago, the price was 45. So I measure the momentum, and it is a, actually, I just realized I got my interpretation wrong here. This would be decreasing momentum, isn't it? That's actually what I want to show. What does that mean? Oh, no, sorry, pardon me. It is increasing momentum. Here is decreasing momentum. And so change today was, compared to where it was 10 days ago, was 8. Tomorrow, we went up to 51. 10 days before that, it was 45. So we're still going up, but we're not going up by as much. And we start thinking about that, and we say, okay, this is decreasing momentum. And if we really sit and we really think about it, what do we want? Eventually, we would anticipate this goes 8, 6, 2, 1. If it seems to be a pattern, we'd anticipate that it gets to 0, and we're going to have no change in the price of our stock, which is the exact opposite of what we want. So we want to see these momentum numbers as being positive, but we also want to see them increasing so that we know our stock is moving fast. And what we can do when we're judging two stocks is look at these momentum numbers. Which one has the greatest amount of momentum? And sometimes we might even want to put a percentage here instead of a price. Which one has the momentum changing the most? So we can look at those in a few different ways. All right. Coming back to the screen now. It doesn't look like we have anybody online quite yet. I'll just go take a quick look at the chat, and it looks like we're still okay there. One of the best momentum indicators that we do have is something called the RSI, the Relative Strength Index. And what the Relative Strength Index does, it takes a look at what happens to the price when it goes down, how much it's going down, and it compares that to how much it will go up when it goes up. And this, it kind of benchmarks it in between going down, going up, between a level of 70 and a level of 30. So I want to go on and I'll take a look at the calculation really quickly. We don't need to worry so much about the calculation. You have that in Edler. I want to go into a little bit more about the performance. I've mentioned this indicator before. I want to show you another bit of insight in terms of how we might want to use it. So here we go again, and I'm just going to go back and share my screen. So I'm going to be moving around a little bit in it. So I apologize for that. So here we go, and you should be able to see the screen now. And again, we have this RSI conveniently set up, and it's this measure here. So it's the relative strength, and it's 100 over the relative strength. So when we take a look at the number relative strengths, we take a look at up closes and down closes to see if we've got overbought or oversold. Now, an oversold position will say that, listen, anytime that this number is larger than 70, that when people are buying it, they're buying, or overbought position, say, when people are buying into the position, not oversold, overbought. When they're buying into this position, they're buying too much of it. There's too many people wanting to buy into this position. So I'm going to take a quick look at Starbucks here and see what we've got. So again, we can use these charts, and we can see up here, the RSI is actually already put on for us. And what I'm just going to zoom in a little bit. Hopefully you can see the RSI. We sort of benchmark it at the 70 level and the 30 level right here. So when it hits this 70 level, it's saying it's really strong, and perhaps too strong, that more people than we would expect, or more people than it can be justified, are buying in. And so we can see right here, once it gets above the 70, you can see that the index goes down. So we typically will use 70, and you can use whatever RSI number you want to indicate overbought. When it hits above 70, that's a signal to us that it's overbought and we should sell. And we just want to come down here for a quick second. I want you to notice what happens here when we got into that oversold territory. So it seems to sort of indicate it right in around, starting it right in around here. But what happens? We see people beginning to pull back once we got into that oversold category, or overbought category. And we can see it again. We can see right around here, we get an indication of being overbought. So we say, great, we're probably at a top then, because there's so much buying going on that it's driven the price up so much. People are now going to be motivated to sell, and we sell. And we sell once we have that indicated here above 70 that it is overbought. We sell it, and hopefully before the price goes down. We have another oversold scenario right in here, and sure enough, the price afterwards began to go down. So we can begin to use that indicator as well, in order to, again, gauge, should we be in this stock, should we be out of this stock. Now, what a good strategy might be, if we're trading, we might want to trade the same stock, just buying and selling it when it's oversold, buying it back when it's overbought. Or selling it when it's oversold and waiting for it to come down below that oversold 70 level when to sort of give us an indicator to buy back in. And we can put that into our strategies. I'll just show you how we might put that into an action plan here really, really quickly. I'll just share my screen with you again. So how might we put that into an action plan? So sell once stock crosses over an RSI of 70, buy back when it dips below an RSI of 60. So what this is, the RSI is telling us, it's not telling us whether it's a good or a bad stock. It's just giving a reflection of if in the time being, if right now, it's actually a good stock to own, or if it's, you know, just temporarily fluctuated a little bit more than usual, it's going to pull back a bit, so we can take a bit of profit here, let it pull back, get back on the bandwagon, and watch it continue to rise. And let's go back really quickly, take a look at Starbucks. So how might we have done that using Starbucks? So we'll call that, present that to everybody. And I'm going to go back into Starbucks. So here we have our RSI. We would have said, okay, great, I'm going to sell. And I would have sold, say, right around here, wait for it to come back a bit. We can see our RSI getting down to 50 and say, okay, maybe, or when it got to 60. So you can see, even though the RSI is going, is sort of declining here, it might be a good time to buy back in. So we'd sell here. We buy back in, and it's not the greatest indicator. So we would have sold at a higher price, bought the same number of shares at a lower price, and then waited again for it to cross over our RSI. So we would have bought back in at, say, 40, it looks like 46.5. And the RSI over here is saying, yeah, no, this went up way too quickly. That's indicating too many people are in, and people are going to want to sell. So it's overbought. And so we would sell back again at 49. Wait till it gets back down to 60. It looks like it gets down to 60. 60 probably isn't a good one, by the way. Maybe we'll look at 50. So if we looked at 50, so we would have sold at just over 47, bought back in at just lower than 46, sold at sold at 49, and then we hit 50 on our RSI, saying, okay, great, it's not in the oversold category. It's going along. It's that upward trend is still going to continue, but it's not continuing so fast, or it's not going to see much of a fluctuation. So we buy back in at 48. We ride it back up to 52, sell it again, and it hits 50 or RSI again, and we go back in at 49. So each time we're kind of selling, buying and selling. We're selling high and then buying back in once the price has dropped a bit. And that's what that oversold is really telling us. We're suspecting the price is going to drop a little bit, and we can take some profits and enhance our position. All right, so I don't see any questions here for the moment. I'm assuming a lot of you might take a look at this afterwards. So I hope that this has indeed been helpful for you. And as always, as you have questions, we can get together and we can talk about those in Google Hangouts. Hope you have a fantastic day. Hope you have a fantastic weekend. I'm really looking forward to seeing your self-reflections into your second week of trading.